Hello and welcome to the second presentation on theme 1 in your booklets, page 81. This is chapter 16, how do businesses find the finances that they need. So the presentation we're going to take a look at is just in the process of loading, and we'll run through this in the same way as we have done previously. So let's take a look at this then. So we're basically going to be looking at types and sources of credit and the impact of credit within the economy. So just to pose you a question, I think that's one of the main characters from Cars. I can't remember what his name was. But anyway, if you wanted to buy a car, how are you going to finance it? So there's a question for you to have a little bit of a thought about, okay? So clearly, if it's an asset that you want to buy, but you can't afford to buy it outright, then you might need to finance it in some shape or form. And we're going to look at the ways in which businesses might choose to finance themselves, but also to a degree how we might choose to finance any of our activities too. So we're going to look at types and sources of credit and the impact of credit that credit has on an economy or within an economy. So some of you might have done sources of finance in business before, if you've done business GCSE, and clearly one of the things we're going to be looking at is the different options and some of the advantages and disadvantages of each. So different types of credit then. We might choose to take out a loan. We might choose to take out what's known as an overdraft, and again we'll explain a little bit more about what an overdraft is later. We might also choose to take what's known as trade credit. I've mentioned that in the previous presentation, where essentially you can take credit from suppliers in your business, where you basically choose to, or you might get use of the goods without having to pay for them in the first instance. You have to pay for them at a later stage, but that's what's known as trade credit. Different sources of credit then. Clearly, banks in some cases might actually provide us with credit or with some form of loans. Okay, other firms in some cases might obviously offer us credit, offer us favourable trading terms, where with effectively, like I said to you before, you might get use of the goods and services before you have to pay for them. Other types of finance that we're going to look at, something called venture capital. Some of you might be familiar with that if you think about Dragon's Den and some of the programs that are on TV these days, which are where organisations or individuals might say, well, this looks like an interesting potential business. We might choose to invest in a particular venture. In some cases, it might be share capital that you can issue, which is another source of finance. And leasing is a means by which we can also raise finance. So rather than paying for something outright, you lease that particular asset and pay an amount per month for the use of that asset. Other sources of finance can include owner's capital, so personal savings. That's something we've touched on already. Retained profit is obviously quite an important one. If a business has been successful and has made profits, then one of the big sources of further finance is retained profit, where a business might choose to keep some of that profit in the business in order to expand. You can also sell assets. So if you've got assets within a business, you can choose to sell those, and that obviously can raise money for you to use in other ways too. And you've also got the option where you could choose to approach an individual investor and say, we've got this potential business, or we need a loan for some money to expand or whatever, and the investor might choose to support you by lending you some money and maybe taking some equity in your business too. There are one of the things that's grown over the last sort of few years with online options and collaborative funding, crowdfunding, and Kickstarter funding, and various other different companies and brands that are offering that. So that's another potential source of finance for business. But we're also going to take a look at some of the challenges in obtaining credit, and in this case, borrowing money, or what some of the issues you might face, depending on the type of business that you are and the sort of track record that you've got. So those are the key things that we're going to be looking at, and how the role of credit and has and what impact does that have on the economy overall. So reasonable amount to get through, but hopefully a lot of this will be reasonably familiar to you. So let's see how we go. Okay, let's take a look at credit then. Basically, if you have a credit agreement of some description, it is considered to be a legal agreement between a borrower and a lender. Okay, so if we take as an example, a business might choose, if they're the borrower, might choose to receive something of value now, so might choose to take stock or finance, and agrees to repay the provider, whether that's a supplier or the lender, at an agreed point in time in the future. Different types of credit can include loans. Clearly, we've talked about loans before. They can be business loans or personal loans. You can also have what's known as an overdraft, which is essentially a short-term loan that a bank will offer you if you've got a short-term liquidity problem, i.e. you can't afford to pay all your bills. You can get an overdraft which will cover that in the short term. They can be quite good and quite helpful for businesses, but they do tend to be quite expensive. The interest rates charged on overdraft tend to be quite high. So that's something to bear in mind. You can also get what's known as trade credit, where effectively, let's say we were selling glasses, okay, so spectacles. We might actually have a deal with a supplier who will say, well, okay, you can have a bunch of frames, which let's say they're worth £1,000, but you can have those immediately to stock your shop, and we want you to pay that £1,000 back in a month's time. So they're essentially allowing you some credit, some time for you to be able to sell some of those goods and services before you have to pay for them, and that's a legitimate form of credit that lots and lots of businesses will use. Sources of credit include obviously banks and other firms. So different types of loan and overdraft and credit facility are available, dependent on the type of institution that's choosing to offer that to you. Let's have a look at loans in a bit more detail then, okay? So effectively what you have is a set amount of money provided for a specific purpose, and that has to be repaid with interest over a set period of time. In some cases, certain loans will be secured against an asset, so that if somebody doesn't actually pay back that loan, if it's been secured, that loan's been secured against a particular asset, then the person who's lending you the money has the legal right to take that asset and sell it, or dispose of it, in order to get the money back that they are owed. Okay. Obviously, dependent on the risk that a financial institution assesses that somebody might be to loan money to, that then is going to depend on the level of interest rate that they will charge. So if a financial institution believes that your credit rating isn't that great, they might say, well, okay, we'll lend you the money, but we're going to charge you a higher interest rate because they're taking a greater risk as a result of that. So in some cases, dependent on the credit rating that you've got, that might then influence the interest rate that a financial institution might charge you or want to charge you, as far as a loan is concerned. In some cases, the belief is that an external source of finance is generally considered more suitable for long-term projects. Essentially, an external source of finance is something that comes from outside of the organisation, so it's not sale of assets or retained profits. It's where you're essentially financing a project that has come from, and the money has come from, let's say, a bank or an investor of some description. Generally considered that external sources of finance are more suited to longer term projects. But that's clearly dependent on the size of the loan and the repayment period, okay? If you're talking about longer term projects, well, clearly in most cases that would mean that the repayment period of the loan would be over a longer period of time. Some advantages and disadvantages of loans that are listed there, and I won't sort of spend too much time on that, but there are a few specific ones I just want to sort of mention. Obviously, some of the big advantages are they're quick and easy to secure. You can, in most cases, agree a fixed interest rate, so that allows a firm to budget. They know exactly how much money they're going to have to pay each month. And in some cases, obviously, if you can get hold of a loan, that can improve your cash flow. That allows you to have more working capital available to sort of run your business. Okay. Some disadvantages. Well, in some cases, clearly you've got to pay interest on that particular loan, regardless of how well you're doing as a business. Okay. And one of the things that we talked about previously is that if you as a business choose to borrow quite a lot in comparison to the amount of money that maybe you're investing yourself, that means that you as a business become what's known as highly geared. So that means that you have a high proportion of the capital that you've used to run the business and create the business has been raised through debt. So effectively, that debt, or all of the debt that you have, carries interest, and obviously if interest rates change and start to go higher, then that clearly becomes a bit of a problem, in that you have then increasing interest payments, and that can be a bit of a risky scenario for you as a business. Okay. In lots of cases, loans, a firm that is providing a loan will sometimes ask for collateral, which is effectively almost like security to say, well, if this loan doesn't work out and you can't pay it back, what are you going to do to make sure that we do get our money back? Okay. Sometimes quite expensive, and in some cases there can also be some penalty fees charged for early payment. So again, depending on the deal that you've struck with your loan provider, that will depend very much on the different options that you've got available to you. Okay. So that's loans. Let's have a look at overdrafts now. Okay, so this is where you're talking about short-term financial issues. Okay, overdrafts are specifically designed for businesses to try to get over that, and some of you might be familiar if you've got older siblings who have gone away to university, where they have actually got their own personal overdrafts, and we'll look at what that means in a minute. Okay. So basically, an overdraft is a facility that you have that you need to agree with, in most cases, a bank, so that effectively in the short term you might have to spend extra over and above what you're going to have in your account. And to some degree, provided you actually agree that with your provider or your bank in this case, that is something that is feasible to do. And allows you to get over any short-term liquidity crisis, i.e. you haven't got enough money to pay the bills, and that is a legitimate source of finance. So in this instance, that means that a business, provided they've agreed with the bank, they can withdraw more money from the account than they've got in there at the moment, at that particular time, and they will go overdrawn, essentially, will go into the red, where effectively any money that they've got in the bank has been used up, and they're actually using a short-term loan, an overdraft, to just meet that short-term financial problem that they may be facing. Okay. Obviously, interest is charged at quite a high level on the overdrawn amount, and it is seen very much as a short-term process. It's not something that as a business or as an individual you want to rely that heavily on, because one of the issues with overdrafts is that they can be withdrawn without warning. So it's something to bear in mind and something to consider. It is considered to be quite a good short-term source of finance, and if you've got a good relationship with your bank and you keep them informed, then in most cases they will agree a certain level of overdraft, provided it's not getting out of control. There will be the opportunity to negotiate that. The most important thing is that you keep negotiating and keep talking to your bank. You don't just ignore it. If you keep going over your overdraft limit, you're going to get punished with penalty fees and all sorts of other stuff. So, but it is considered to be an external source of finance, and it's provided generally by banks and building societies. Generally speaking, you would only get an overdraft based on the fact that you've got an account with a particular financial institution, and if you've got a decent track record, then chances are that if in the short term you've got an issue that you need to cover, they will be willing to help you as far as that's concerned. Some of the advantages and disadvantages, a little bit like we listed for loans. It is quite a flexible source of finance. You're only paying for the money that you borrow. They're quick and quite easy to arrange. And there's no charges for paying off your overdraft, with the exception of the interest that you'll pay. So once you've paid off your overdraft, that's it. Happy days. You're back in a decent position. Okay. Disadvantages, like I mentioned to you before, the bank can sometimes call that in at any time. Sorry, I've got a landline call in the background, if you can hear that buzzing. So they're only generally available from the current bank account. Interest payments tend to be variable, which makes it quite tricky to budget. And in some cases, the banks might actually require an overdraft to be set against different business assets. Okay. Oops. Okay, so let's take a look at the next type of credit then. The next type of credit is known as trade credit, which we talked about briefly already, but let's go into that in a little bit more detail. Okay, and this basically is where you've got a situation where you pay suppliers a period of time after the goods and services have been received. Okay, so there's an example then. So a supplier might be providing business with finance for a period of say 30 days. So that would mean that I might take, if we take the spectacles example, I might take delivery of my £1,000 worth of spectacle frames, but I don't actually have to pay for those goods until 30 days after I've received the goods. Now that means that if I'm managing my business well, I might be able to sell some of those spectacle frames prior to the 30 days and hopefully be in a position where I've made a profit as well. I can pay back my my supplier within that 30-day period. And also that allows me then to hopefully expand my business and maybe then agree another deal after the 30-day period where I might be able to get even longer amounts of credit from my supplier if I'm considered to be reliable and that I'm paying my bills on time, so to speak. So in some cases, businesses can sometimes use this as a means to actually, in some cases, so rather than taking credit, in some cases a business might say, well, if if I pay early, if I pay for my goods early, or pay for them as I receive them, then can I get a discount on the overall price? So in some cases, that quick payment might actually be something that individuals might consider or businesses might consider. Okay. Other sources, some of the sources of credit, we've obviously talked about banks. Okay, we've talked about the fact that they are licensed to take deposits, pay interest, make loans, and clearly banks are quite a good source of credit. Although to be fair, they're not quite as helpful in terms of loans as maybe they have been in the past, where for various issues with as far as the financial crisis is concerned, that sometimes has caused banks to be a bit more cautious in terms of the way that they loan money. Now, in some cases, you will have banks that have specific departments and employees who specialise in business banking. And clearly, if you've got a decent relationship with your bank, then hopefully they can offer you all sorts of help in terms of financial planning and business planning, in addition to the loans themselves. Okay. You might find that other firms would be willing to provide you with some form of credit. We mentioned that suppliers who supply goods and services, they might allow some customer trade credit, and that clearly can be a decent source of finance for a business. But you've also got other sources of finance like venture capital. Okay. So in this instance, what you've got, and if you like, the best example I can think of that you're likely to have seen is probably Dragon's Den, where you get investment from an established business into another business, and they will take a percentage of equity in the business. So how many times do you see Peter Jones or another saying, right, well, I'm willing to give you £50,000, but I want 30% of the business. Okay, so they're willing to invest, but they are likely to take a slice of the ownership of the business in return for that investment. Sometimes known as private equity finance. And generally speaking, venture capitalists, because they're taking a risk, they're looking for high rates of return within a specific time period. And if they don't get those, then clearly they're going to, I wouldn't say kick and scream necessarily, but they're likely to be quite, what's the word I'm looking for? Quite strident in expecting those high rates of return to be provided for the risk that they've taken. One of the big issues, one of the really good positive issues, is that in some cases the business or the entrepreneur who's looking for this finance might also benefit from being mentored, or the expertise that the venture capitalist can bring to. And more often than not, those people that are looking for venture capital are probably saying, well, we think we've got a good idea, but we need a bit of help to develop it further. And in this case, obviously, venture capitalists can provide that as a source. Often associated with quite high-risk startups. Okay, so where people haven't necessarily got a fantastic track record, or they might be coming up with something that's quite new and different. And to some degree, venture capitalists will be taking a little bit of a view on that. And obviously, if it's considered to be a high-risk startup, then they're probably likely to want more of their a greater share of equity for the amount of money that they're willing to put into the business. Some of the advantages, well, clearly in some cases, if you've got a good idea, then there's potential for venture capitalists to provide you with significant amounts of investment along with expertise. I think if venture capitalists are willing to take a bit of a risk, then it might make it easier for you to find other sources of finance in the future. And it clearly can provide, more often than not, the required capital for expansion. So in most instances, successful companies that use venture capital are using it to fund expansion of the business, maybe scale up the business, produce more, maybe go and target larger customers, etc. So there are some serious advantages. However, there's some disadvantages too. It's quite a long and complex process. You're probably going to need to be quite good at putting a business plan together, because how often do you watch Dragon's Den? And more often than not, the people who are being challenged on the figures don't know their figures, and they don't know their financial projections. Well, clearly, if an organisation or an individual is willing to spend some money on investing in your business, you've got to know your numbers inside out. And if you don't, then more often than not, people are going to say, well, unless they see it as a great idea, but actually they're more often than not, if you haven't got your numbers sorted, then that can be a major stumbling block. Okay, it can be quite expensive for a firm initially, because you've got legal and accounting fees that you might have to consider. You've also lost some of the ownership of your business. And there is a danger that you're going to get conflicted views, and also you're going to get interference, possibly, particularly if you've got an organisation or an individual that's quite confident and brash, maybe, and is willing to tell you how you should be running your business rather than acting as a support, which clearly can be a bit of an issue. Let's have a look at share capital then as the next example. Okay, so this is finance that's raised from the sale of shares, also known as equity capital, essentially where a shareholder is going to become a part owner of a business. Okay, so effectively, an individual will buy shares in your business, and in order to do that, they will part with some cash, and they will then get shares in your business too. Okay, two ways in which they get invested rather than rewarded. One is by the payment of dividends. So if a business is successful and makes profit at the end of each year, the company will declare what's known as a dividend, which essentially is a share of the profit that each individual shareholder will receive, depending on the amount of shares that they might have. Okay. The other advantage clearly is that if the business is successful and is regularly profitable, then that's going to mean that the price of the shares that maybe let's say they might have been bought for £5 per share originally, might go up to £10 over time. And clearly in that case, the value of the shares have increased, and should a shareholder choose to then sell their stake, then they can obviously make a profit on that too. Okay, so there are some real benefits as far as that's concerned. Okay, it's only really an option for what's known as an incorporated business. Okay, either a private or a public limited company. Remember, we talked about limited and unlimited liability. In this case, you have to be a limited company in order to issue shares. Okay, you can only issue shares in an incorporated business, which essentially means that the legal entity of the business is separate from the individual who runs the business. Okay, and that's a sort of legal position that's quite important. But if you want to raise share capital, then that's one of the things. You either need to be a private or a public limited company. Some of the issues around share capital is it can be quite complicated, it can be quite a costly process, and again, share capital, generally speaking, is best suited to where you're raising large amounts of finance to fund long-term projects of some description, maybe expansion projects or diversification projects, perhaps into new markets. Advantages and disadvantages of share capital then. So three listed for each. So in some instances, advantages are that you only have to pay dividends if the profit is being made, and you don't have a fixed dividend that you have to pay. Clearly, one of the things that you want to try and do is offer decent dividends each year if you can. Because that's just going to mean that people are going to be satisfied and happy that they've made a decent investment in the first place. But also there's a possibility to raise large amounts of finance, and clearly you don't have to pay any interest. Basically, the the amount of money that is generated is based on the share price that you issue your shares at, and effectively anybody that's buying shares in your business will hopefully get some benefit via either dividend or an increase in share price, but that you don't have to pay interest on the money that people have bought their shares with. Okay. Some of the disadvantages: you can lose control, you lose ownership of the. If you lose, let's say you sell more than 51% of your shares, then you've got no control over your business whatsoever. Okay. There is also the danger that you might lose control if you're talking about a public limited company, where you might find that businesses choose to be quite hostile in the way they might choose to try and take over your business. Okay. And again, if we're talking about a public limited company, issuing shares can be quite a costly and quite an expensive and complicated process. So that's something also to bear in mind. Okay. Let's have a look at other types of finance then. We've got leasing as an example. Okay, and this essentially means that you're able to use an asset within a business without owning it or buying it outright. Okay, so in this instance, what you choose to do is a business choose to pay a set amount per month in instalments to lease the asset for a predetermined period of time. Okay, now that clearly helps in terms of cash flow, because instead of having to buy something outright, you're only having to pay an amount per month rather than the whole amount. Okay. Now, in most cases, the asset that you're using becomes, or not in most cases, in all cases, the asset remains the property of the leasing company at the point up until the point at which that time period has elapsed, and then effectively that asset is normally then returned to the leasing company, and the business stops making those payments. Now, in some cases, you might choose to, you might have to pay a balloon payment of some description, but you might have the option of buying that particular asset at the end of that time period. But generally speaking, what probably most businesses will do is would then say, well, okay, we've used that lease, let's start a new lease for a new piece of equipment or a new asset. Clearly, one of the things that allows is that it avoids having to finance the asset, but it can be more costly in the long run. And in some cases, the lease company might be responsible for any repairs or maintenance, dependent on the type of contract that you've agreed with them. In some cases, one of the reasons why people choose to lease it, well, two reasons really. One, obviously, it reduces their cost per month of running a particular part of the business, and also it means that at the end of that particular term, you might choose to then get a new specification. You can get the latest model as opposed to sticking with the old one that you've used up and maybe has seen better days. But that is a legitimate form of finance for business leasing. Okay. Let's have a look at some other sources of finance. Then we've got owner's capital, so personal savings. Okay, so clearly, if an entrepreneur chooses to invest his or her own money from personal savings, that is a form of owner's capital. Okay, that's very much the amount that the owner has chosen to invest in the business. It also shows the proportion of a business's assets that are owned by the business owner rather than by creditors. So it's normally quite a good sign. If you've got a relatively high level of owner's capital, that means that obviously the individual is personally invested in that business and is obviously has the reasonable level of asset value within the business too. Things that might be owned by the business could include stock, such as current assets, or it might be vehicles that are long-term assets, or it could be you've chosen to buy your factory or your premises, and that obviously can all be different forms of assets that that businesses can have, and owners, if owners own those assets, then clearly they are things that they can choose to sell if they need to. Creditors are people that that the business owes money to. So, for instance, if a business has got a loan out, then obviously then they have a long-term commitment to pay that back, and that means that they have got creditors that they need to make sure that they pay back. Let's have a look at some of the benefits of personal savings then, okay? Now, to some degree, there are obviously a number of very good reasons for having those personal savings. You don't have to repay anything. That's money that is yours, that's within the business. You've got no interest charges on those on those personal savings. Okay, it means that you, as an owner, can maintain greater control. If you've got your own personal money that you're using, you can then control that control the business to a much greater extent. Okay, there is an argument to say that if you've put your own money into the business, that's going to be more motivation. It's going to make you work hard to make sure that the risks that you've taken are worth it, and that creates its own set of motivations. Okay, you clearly don't have to go through any lengthy application procedures, because basically you choose to put that money into the business. You haven't got to agree it with anybody. You basically just put it in and use that money to run your business, essentially. However, one of the issues is that clearly, unless you're very fortunate and you've got a bottomless pit of personal savings, that at some stage is going to be limited by the amount of spare capital you've got knocking around, basically. And clearly, if you've got high levels of personal saving within your business and the business takes a bit of a downturn, or for whatever reason, then there is a threat to personal finances and family finances should you choose to go down that route. So that's something worth bearing in mind too. Other sources of finance then. So we've talked about a number of external sources of finance, both owner's capital and also retained profit are known as internal finances. So in this instance, obviously retained profit is where you're keeping, after all the costs of a business have been taken out from year to year, then obviously if you've made a profit, you might choose to keep some of that profit within the business to help finance your future activities. Well, clearly there's some massive advantages to that. One, obviously, if it's profit that you've generated, you're not paying interest on that finance. It doesn't dilute the business ownership, because effectively it's money that you've generated yourself as a business. But clearly, it's only a source of finance provided you've got sufficient profit that's been generated by the business. Okay, and there is an argument to say that if you're spending too much of that profit on keeping it within the business, then you might find that certain shareholders get a bit fed up because they're not getting the dividend payments that they would like. And clearly, one of the other issues is that retained profits can be a really good thing, in that they give you a little bit of fat to live off, if you like. But clearly, in certain situations, if you're starting to use retained profits for other things to expand, then that could potentially mean that gives you a bit of a problem in the future should things change. Okay. Few examples there: Stagecoach reinvesting £80 million worth of profit in 470 new buses, and clearly lots of organisations will use retained profits where they've been successful in their previous year's trading to actually expand the business and develop it further. Okay, other sources of finance then, you can choose, if you've got assets within the business, you can choose to sell those assets. Okay. So assets are any items that are owned by a particular business. Examples include current assets that are items that will change in value in the short term, normally within a year. That tends to be things like stock of goods and services. Okay, so current assets, relatively easy to convert into cash. Stock is one example, okay, because that's being bought and sold on a regular basis in order that you can, obviously, in this case, let's use the spectacles example. If we got high levels of stock, or we've got high levels of demand for our stock, we're going to then hopefully finance that via maybe some trade credit. But then the stock we can actually convert into sales quite quickly. And that obviously is a means by which we can actually generate sales and sales revenue. If we're talking about sales of assets, they tend to be more specifically relevant to longer term or fixed assets. Okay, examples like a fixed asset is any asset that's likely to stay in the business for longer than a year. So it could be machinery, or it could be vehicles, or it could be premises or land, or something of that nature. Okay. Now, clearly, if we choose to sell some of those assets, maybe they've got to the end of their useful life. What that does mean is that effectively, if we sell that at a price, we can get an immediate injection of cash into the business, and that provides a source of finance for the business to maybe develop in a slightly different way as a result. Some of the benefits, well, clearly, if we choose to sell some assets, we're not going to be getting charged any interest on that, or any repayments. And we might actually be able to take an old asset that we don't find useful anymore and can convert that into money that we can then use to finance the business into the future. In some cases, depending on what asset it is that you're selling, you can get an immediate lump sum cash injection into the business, which can help in terms of cash flow, but also help in terms of the efficiency of the business. However, in some cases, it might be expensive in the long run, and also we've got to bear in mind that if you start selling assets that are critical to your business, that might affect the level of ability that you've got to produce stuff in an efficient way. You do have the option in some cases where you might choose to sell the asset and then lease it back, which is a very specialist form of finance known as sale and lease back. So you sell the asset, but then you effectively lease that asset back from the person that you sold it to. Okay, that's something that you can do. However, clearly, if you choose to sell that asset, okay, you've lost the use of that asset within your business and any future value that might have had previously. Okay, it's clearly only a one-off option. You're only going to be able to sell an asset once. You're not going to be able to sell it again. Once you sold it, that's it, done. Done and dusted. You need to then move on and consider other sources of assets, or sources of finance rather, not sources of assets. Other options then, individual investors. We could get friends and family to invest, okay, people that are known to the entrepreneur. That obviously is going to be slightly limited by the contacts that you've got, and also the number of people that you might choose to offer that to. And in that instance, if we're talking about an individual investor, we might be able to agree certain repayment terms, or to have conditions in the future that might be flexible, dependent on the relationship and the business sort of activities that you've worked with that particular investor in the past. Can obviously place some pressure on relationships. Let's say you choose to go down the family and friends route, and then actually you're not able to provide the returns that ideally you would like. Then that obviously can create its own set of issues, as you could imagine. You can also get something called peer-to-peer funding. This is relatively new. I think it's also known as P2P, and that's basically where an individual lends to another individual, where there's been previously no relationship or contact. So to some degree, that could be something like a crowdfunding or a Kickstarter type scenario, where There are websites available that you can go and take a look at different potential investment opportunities, and you don't need to know that individual. You might think, well, that seems like a good idea, I'll put a few bob into that. So that's another potential source of finance. Okay. In some cases, you might also find that borrowers will be given a credit rating in that scenario, and in some cases, or in most cases, that's going to be an unsecured personal loan. Although in some cases it tends to be a relatively small amount, generally speaking, but there might be some collateral that may be offered. So, for instance, if you were talking about some sort of peer-to-peer funding, you might say, well, okay, if you do choose to invest in a particular idea or concept, then we'll offer you discounts when we finally bring the prototype to market. So there are some deals to be done as far as that's concerned. Okay, certainly cuts out the traditional use of intermediaries rather than being reliant on banks. And part of the reason why this peer-to-peer funding has grown to such a degree is that banks simply aren't loaning in the ways that they used to. So that sort of filled a gap, if you like, that banks have left, where they've been a bit more cautious about lending money to businesses than maybe they were in the past. Lending tends to get done online via this route, and in some cases you might also find there are issues around lender might actually choose who they want to lend to, and then compete to win that lending opportunity in some sort of reverse auction. So the lender is willing to offer the lowest interest rate wins, sort of thing. So it becomes a bit more competitive, essentially. And obviously that's going to work if you've got a particularly attractive business. And it's not going to necessarily work if it's not the greatest business idea that we're talking about. Obviously, the lender's motive in this instance is to make a profit, and so obviously, if you were to get involved in some sort of peer-to-peer funding, then clearly it's very important that you demonstrate that you are going to be successful, and here are all the benefits and the reasons why that people should lend money to you in order to fund your business into the future. Okay, other sources of finance. Well, this is sort of related a little bit to peer-to-peer funding, but very much about online collaborative funding and crowdfunding in particular. Okay, it involves raising finance from large numbers of people. Normally speaking, they're going to be relatively small investors, and they're investing relatively small amounts of money. So the business actually uses the internet to explain how much money they require, how it's going to be used, what their exit strategy is going to be, and what they think they get the sort of return on investment that somebody might expect. And then on that basis, the investor is only tied into their promised contribution if the total amount is raised. Okay, there is a short video which explains crowdfunding. And there's a link there that you can go and take a look at. It's a BBC News article. It's about 2 or 3 minutes long, so that's worth going and having a look at as far as crowdfunding is concerned. And then let's just take a look at some of the challenges of obtaining credit. So one of the big issues these days are this issue of credit ratings, and that each individual business and each individual has a credit rating depending on how well they've managed credit in the past, and that obviously then has an impact on number one, whether people will be willing to lend money to you, and number two, the sort of interest rates that they might be willing to charge you to. Okay, so in some cases, particularly for a new business, if you've got no business track record, it can sometimes be quite difficult to access credit straight away, and you have to build that credit profile up over time. Now, each individual has the opportunity to do that, and you've probably seen things like ClearScore and Experian that have advertised on TV, which actually provide you with a means of actually checking what your credit rating is looking like, and ways in which you can improve that over time. So lots of banks, lots of businesses that are in the finance business will take a look at some of these credit ratings in order to assess how risky that they see that loan being. And obviously, if they see it as quite a high risk loan, they're going to charge you more interest. So effectively, the greater the risk, the higher the amount of interest that's going to have to be repaid. And clearly, you as a business might say, or you as an individual might say, well, I'm not willing to pay at that level. But clearly, if that is the case, then that means that you can't access that particular form of finance. Sometimes in these sorts of situations, if you can provide some sort of collateral, some sort of asset that you can use as security for the loan, that sometimes can help, both in terms of the interest rate that people will charge you, but also the fact that you're willing to say, well, if I don't repay this, then this is an asset that you can use to sell to actually pay off the debt, so to speak. Okay. Sometimes you might find that individuals will ask for somebody to be a guarantor for a loan, for instance. So, for instance, let's say you decide you're going to buy yourself a little car, and you're going to then finance that through some sort of loan. If that loan is something that maybe you might struggle to, or the business that is going to sell you that loan or finance that loan for you, they might feel, well, we'd like some sort of guarantee such that if you're not going to pay back, then somebody else will. So that could be a parent or a friend that is willing to act as a guarantor. So sort of underwrites the loan, if you like. So let's say, for instance, I choose to borrow some money, and I'm not able to pay it back, but I have a guarantor of a loan of a rich uncle or something similar. Then if I fail to pay, then my rich uncle in this case would sign a contract to say that they would be willing to pay that money back on my behalf. So that basically finish off that presentation. Quite a lot of detail there, but hopefully it was all reasonably straightforward. And I shall post this onto Teams so that you've got that as an option to take a look at in the future. So thank you for watching, and hopefully you found that reasonably interesting.